After years of grappling with rising costs of living, Americans are finally catching a break. Inflation in the US took a surprising dip, falling by 0.1% month on month in June, beating expectations of a 0.1% rise. On an annual basis, consumer prices rose by just 2.97%, which is the smallest increase in over 3 years. This trend marks the third consecutive month of decline and brings inflation to its lowest pace since 2021. With this welcome respite, speculations are rife that the US Federal Reserve might soon pivot towards interest rate cuts. How soon, you may ask? According to the CME Fedwatch Tool, which is extremely useful for monitoring the probability of upcoming FOMC policy moves, there's a striking 93% probability of a Fed rate cut by September of this year. Even Fed Chair Jerome Powell, who had been tight-lipped on timing, recently underscored the risk of prolonged high interest rates, warning of potential economic slowdowns, recession, and significant job losses. Now, with the economy showing signs of deacceleration and price pressures easing, all signs point towards imminent rate cuts. So what does this mean for India? Let's delve deeper into the potential effects. Let's start with potential implications on bond yields and equities. If the US Federal Reserve cuts interest rates, it's likely to lower bond yields, making investments in stocks more attractive. This could trigger a risk-on sentiment globally, benefiting stock markets in emerging economies like India. Investors often seek higher returns in markets where risks are perceived to be lower compared to bonds, and that's what they would get with lower interest rates. Moving on to the impact on rupee, a weaker dollar due to lower interest rates in the US typically strengthens other currencies, including the Indian rupee. A stronger rupee makes imports cheaper, potentially easing inflationary pressures domestically. This could be particularly beneficial for sectors reliant on imported raw materials or goods. Speaking of imports getting cheaper imports facilitated by a stronger rupee could translate into lower overall inflation rates in India. This would provide relief to consumers by reducing the cost of goods and services, supporting higher disposable income and potentially boosting consumer spending. Then there is global investment sentiment. During periods of US monetary easing, global investors often look to diversify their portfolios into emerging markets for higher returns like India. India, with its strong growth potential and reform-driven economy, could attract increased foreign direct investment, which is FDI, and portfolio flows. This influx of capital could further stimulate economic growth and infrastructure development in the country. In summary, India stands to benefit from potential ripple effects. Lower inflationary pressure, a stronger rupee, and heightened investor confidence could collectively contribute to a more stable economic environment.